Welcome to Talk Tickers. Today, we're diving into a classic Wall Street head-scratcher. Tractor Supply just reported a really strong third quarter, but the stock, it took an immediate nosedive. We're going to break down their October 23rd earnings call and figure out exactly what happened. All right, let's just get right to it. On the surface, everything looked great. Tractor Supply posted a solid earnings beat for the quarter. So the big question is, why on earth did the stock immediately tank by about 6% in pre-market trading? That's the puzzle we're here to solve today. So, first up, let's lay out the two sides of this story. We're going to look at the headline numbers, the actual results, and put them right up against the market's immediate, and let's be honest, pretty brutal reaction. And this slide really says it all, doesn't it? Over on the left, all good news. Earnings per share, or EPS, came in better than expected. Revenue was right on the money. But then you look to the right and you see the market's verdict, a sharp sell-off on heavy volume. This is just a perfect example of investors caring less about the past, that great quarter, and way more about what they fear is coming in the future.
Okay, so to really understand why investors got so nervous, we need to pop the hood. We're going to look past those headline numbers and dig into the nitty-gritty details of how the company actually performed.
So just look at this table. On paper, this is a business that is executing beautifully. EPS is up almost 9% from this time last year. Revenue grew more than 7%. And comps, that's comparable store sales, a key metric for retailers, were up a really healthy 3.9%. They even got more profitable, expanding their gross margins. Operationally, it's really hard to find anything to complain about here. And this chart just helps visualize that top-line number. I mean, in a retail environment that's been pretty challenging for a lot of companies, pulling off a 7.2% year-over-year revenue jump, that's a really significant accomplishment. Now, here's a really crucial detail. When you break down that comp number, look at what drove it. The growth came more from a 2.7% increase in the number of transactions, not just a higher average ticket. And why does that matter? It means more customers were actually coming into their stores and buying stuff. That's a sign of a really healthy, engaged customer base, not just a company jockeying up prices. So with all these strong numbers, you can imagine management was feeling pretty good on their earnings call. Let's take a look at how they presented their case. CEO Hal Olton really set the tone with this quote. From the company's point of view, this was a mission-accomplished kind of quarter. They see themselves as not just doing well, but actively stealing market share from their competitors in their core life out here niche. And they pointed to a whole list of highlights to back that up. Things like record customer loyalty, awesome digital growth, and they're still expanding, opening 29 new stores. Plus, they're sending cash back to shareholders. From the inside looking out, this is the picture of a fundamentally strong and growing business. So, if the business is so healthy, what did Wall Street see that it hated so much? Well, this brings us to the real culprit behind that stock drop, what we call guidance jitters. This is so important. Wall Street has a one-track mind sometimes. They looked right past all those great Q3 results and focused entirely, 100%, on one thing, the company's forecast for the rest of the year. And here it is. This is the smoking gun. Now, they didn't actually lower their guidance, but they did something very subtle. They narrowed the range for all their key metrics. By tightening that range, they essentially shaved off the high end of what was possible for the year. And to investors, a subtle shift like that, it screams caution. It's a signal that maybe things are slowing down a bit heading into the fourth quarter. This analyst quote just nails it. The market completely latched onto that guidance tightness, and it led to what's called a softer tape. Basically, the stock just traded weakly all day. All those positive operational facts we just talked about, they got totally ignored because the market was more worried about what might happen next. All right, so that's the what and the why behind the market's reaction. Now it's time for us to look ahead and give you our verdict in our segment, The Next Call. We're going to break this down for you into 3 simple parts. First, our prediction for Q4. Second, our outlook on where the stock price might go from here. And finally, our official equity research style rating. For the fourth quarter, we predict their comps will probably land right within that new, tighter guidance. But here's the thing you have to remember about Tractor Supply. The real driver isn't holiday sales. The true wild card is winter weather. A major cold snap, a big snowstorm, that's what drives sales of things like animal feed, heated buckets, and winter gear. That will move the needle way more than any Black Friday sale. So given all this uncertainty from the guidance, we expect the stock to be pretty choppy in the near term. It's in what we call a show me state. Investors need to see proof of strong results before they're willing to bid the price back up. A real sustained move higher is going to need a catalyst, something like a cold start to winter that proves the market's fears were a little overblown. And all of this brings us to our final rating, market perform. Now, this reading is all about balancing two competing ideas that are both true. On one hand, Tractor Supply is an absolutely best-in-class company that is executing its strategy almost perfectly. But on the other hand, the market's broader concerns about the economy, which that tighter guidance seemed to confirm, are real, and they just can't be ignored. So for now, the stock is likely to perform right in line with the broader market until we get more clarity. And as always, just a reminder, this is not financial advice.